It is 1 o'clock. We'd like to go ahead and get the meeting started if we could. First off, welcome to everyone that's here today. I would ask that if you have any cell phones or other electronic devices that might squawk at us during the meeting, please silence those. And at this point, I would ask the chair to call the roll, or the clerk to call the roll, please.
Senator Berg, Senator Carroll, Senator McDaniel, Senator Mills, Senator Neal, Senator Nemus.
Present.
Senator Wilson. Here. Representative Bojanowski. Here. Representative Fleming. Representative Graham.
Here.
Representative Petrie.
Here.
Representative Pratt. Here. Representative Tipton.
Here.
Representative Weber.
Here.
Mike Harmon.
Here.
John Hicks. Victor Maddox, Sharon Mattingly, Representative Hale, present. Senator Higdon,
Here.
Representative Johnson.
Here. We do have a quorum. Having a quorum, we are duly constituted to conduct business, and the first order of business for the day will be to approve the minutes from the April 24th meeting. To have a recommendation for approval.
So moved.
Have a motion and a second. All in favor? Aye. Minutes are approved. And the next item on business is to hear from CERS concerning the actuarial experience study. If the presenters would come forward, please. Good afternoon.
Good afternoon.
So if you would make sure that green light's on, introduce yourself and any guests you might have, and the floor is yours.
Thank you very much, Chairman Johnson. It's with great pleasure that I'm here today to discuss the experience study conducted by the County Employees Retirement System. My name is Ed Owens. I am the Chief Executive Officer of the County Employees Retirement System. With me via Zoom are representatives from our actuary, GRS, Janie Shaw and Danny White. And also we have with us David Lindberg, who is representing Wilshire. Wilshire has been, since 2017, our investment consultant. I'm excited to have the opportunity to go over with this oversight board the considered and patient work that our board has done in looking at the assumed rate of return for all of our plans. We've gone through a very deliberative process. It started with our actuary committee, which is chaired by Mike Foster, back in March of 2022. The committee then initiated the idea that we wanted to look at the assumed rate. We also had the involvement of our investment committee. Dr. Merle Hackbart is chair of that committee, and he also sits on the actuarial committee. On November 2nd of 2022, the actuarial committee looked exclusively at the assumptions and the forward-looking return expectations for our plans. We met again on April 12th of 2023 to go over the same process. So for two complete meetings, the actuary committee, who took the lead here, but supplemented and helped by the investment committee, looked exclusively at return assumptions and forward-looking returns. It was on May 9th of 2023 that our entire board decided to move the assumed rate of return for our plans from 6.25 to 6.5. The implementation of the new assumed rate of return. The actuarial assumptions will be used to prepare the June 30, 2023 valuation. That valuation will first be presented to our board in November of 2023 and will be approved and adopted by the board in December of 2023. That will involve the contribution rates for fiscal year 2025. So the contribution rates that have previously been adopted by the CERS board for fiscal year 2024 remain unchanged. Even though the assumed rate of return is a forward-looking assumption, one of the things that our board wanted to ensure that we did was to look very closely at what had transpired in the past. So we compiled a list of returns for our plans for the last 10, 20, and 30 years. What's presented here in this slide deals with our pension non-HAS, but all of our plans are similarly performing. So the 10-year return as of the end of fiscal year 2022, 7.32%. The 20-year return as of the end of fiscal year 2022, 6.64%. And the 30-year return at the end of fiscal year 2022, 8.82%. We wanted to include this slide, which is from our finance committee, because we wanted to ensure that the committee was aware that we're very much looking at funding, at liquidity, at our net contributions. So this report represents our pension system. You'll see that from fiscal year 2022 to fiscal year 2023, there have been considerable increases in both member contributions and employer contributions. The total outflows or total inflows for both the non-hazardous and the hazardous programs for fiscal year 2023 are greater than the total outflows. So there is a net contribution to our plans based on 2022 to fiscal year 2023 numbers. I'll also draw your attention to the last line on this slide, which is yield as a percent of assets. You'll see that in both hazardous and non-hazardous plans, the yield as a percent of our assets has fairly substantially increased. Looking at the insurance plans that we have, the insurance plans have behaved exactly as we would expect an insurance plan to behave that is over 100% funded. You'll see that the employer contributions for fiscal year 2023 are substantially lower than they were in fiscal year 2022. We are over 100% funded. The net contribution for hazardous is somewhat negative, but not much. That's what you would expect in a very mature, well-performing plan. The capital market assumptions, and David Lindberg again is on the phone, and I'll ask him to speak to some of this, but I wanted to first show the board what the forward-looking assumptions have been from our investment consultant. You'll see that in general, they believe the 10, 20, and 30-year forward-looking assumptions are extraordinarily positive going forward for equity, for fixed income. You'll see core fixed income substantially up at 4.5% cash up at 4%. Those were numbers that would not have been present had we been looking at this in years past, a function of what's happening in the larger economy as relates to interest rates. But when you drill down on this and look at our current policy and what we're doing in terms of how we've allocated our portfolio, the return assumptions for our portfolio are 10-year over 7%, 20-year over 7%, 30-year over 7%. Now, one of the things that you'll see when we look at our experience study is that our actuary actually looked at up to 12 investment consultants to look at what they perceived the forward-looking returns would be. So we hire Wilshire to work with us. Here's Wilshire's view of what 10, 20, and 30 years will look like for our plan. But the actuaries will tell you that of the 12 investment consultants that they looked at, the Wilshire projections are almost squarely in the middle. There were a number that were higher, there were a number that were lower. With that, I'll ask David Lindberg to walk us through the efficient frontier and what that means and how we will move forward looking at our portfolio. David, you're muted. There, David? Okay. David, can you hear me? Okay. I'll continue to walk through this. What the efficient
Ed, I'm sorry. Can you hear me now?
Yes.
Okay, great. Sorry about that. Sure, I'll just walk through this for a minute. The efficient frontier is an evaluation of the levels of return we can accomplish for different levels of risk on a forward-looking basis, focusing only on the assets. This is one of the components of an asset-only analysis, not a full asset liability study. In this case, just focusing on the assets, but plotted along the frontier based on the constraints that we put into that frontier, which reflect several very practical things in terms of how the plans might allocate assets. That line is a line that shows the maximum return for each level of risk that is taken along that bottom axis. The red circle is the current policy allocation, which runs at just under 13% forward-looking volatility. So standard deviation of returns, that would be the risk level in this case. And you can see where that plots in terms of expected return around 7.5%. So this is reflecting forward-looking over the next 10 years, level of expected return, level of expected risk for that policy allocation. And the significant increase that you referenced relative to allocations or relative to assumptions in the past reflects where we are today with substantially higher interest rates than a year and a half ago. The second thing that this chart also shows us is that you could also reduce risk to a certain degree and still achieve the expected returns that you would like to achieve. So that we will dig into further with an asset liability study later in the year, but this gives you a sense of how just that asset only efficient frontier works and what it speaks to in terms of risk and return for the plan assets. Okay. Then as we go forward from here, this is looking back over 1, 3, and 5 years, some very strong statistics. These are on this chart we're showing here are the pension plan assets. And if you notice on that first chart, untitled return, if we just go to the 5-year data points, the pension plan in total has had a 6.29% expected return over the trailing 5 years, which is in the 34th percentile of this universe of other public plans, where the median public plan returned 5.96 during that 5-year period. But more importantly is that risk level to the second chart, where over that 5 years, this was accomplished with lower risk than most other plans, a level of risk, that being volatility of asset returns over the 5 years at 9.19% was in the 6th percentile. So lower risk than 94% of the other public plans in that universe, and yet accomplished returns that were better than roughly 2/3 of those plans in that universe. So looking back historically, very strong risk-adjusted returns. The final chart titled Sharpe Ratio is exactly that. It's the risk-adjusted measure, showing that over 5 years, a measure of 0.55, indicating that you were better compensated for the risk that you took over the trailing 5 years than 93% of other funds in that universe. And we see similar results for the insurance plans. You could see very similar numbers: 5-year returns in the 38th percentile, 5-year risk level in the 4th percentile, meaning less risk than 96% of the other funds in the plan, and yet higher returns than 62% of those funds. So that's some historical context to share in terms of not just return, but also risk and then risk-adjusted returns.
David, thank you very much for sharing that information. The actuarial experience study, I'll turn that over to Danny White and Janie Shaw. As everyone on the Oversight Board knows, KRS 78784 would require our system to conduct an experience study before we determined that we would move the assumed rate. Danny, Janie, I'll turn it over to you.
Great. This is Danny White with Gabriel Roeder Smith. With me is Janie Shaw. Gabriel Roeder Smith. Janie, would you actually be interested in going over the demographic side, and I'll cover the economic?
Sure. It looks like we're going to actually start with the economic assumptions here.
Okay. Well, we'll dig more into the economic side further on, but there were a number. This was a total and comprehensive experience study that looked at all the demographic assumptions and the economic assumptions. It's all the assumptions that go into the valuation. So as a reminder, in the valuation process is we receive valuation or census data from the retirement system. Every member who's due or entitled to benefit, either who's currently accruing a benefit or who is no longer an active member, but is either receiving a benefit now or going to receive one in the future when they're retirement eligible. And with that, we build into assumptions, number of economic, demographic, on behavior, how investments are expected to perform during that time period, salary increases, payroll growth, and that. So with that develops a liability, which feeds into, you compare to the assets, and ultimately the contribution rate to shore up our how do you fund that difference between the liability and the assets. But with that, on the price inflation, we recommend an increase from 2.3 to 2.5. The investment return assumption, we recommended 6.5, but we also recognize the risk that if the board wanted to stay put at 6.25, that would also be sensible. The cash balance interest rate, this is only on tier 3 members, 6.75, and what that difference recognizes there's a 4% floor. So while there's no minimum or no bottom on the investment return experience on the cash balance interest credit, there's a 4% floor that they won't receive anything less than that. So there's a difference there. And then we make other assumptions on individual salary increases that they get through their career. We increased that at certain levels, and then the payroll growth doesn't impact the liability. It's more the financing. The system collects contributions as a percentage of payroll. And so this is kind of your revenue growth assumption. How do we expect that payroll to change over time in collecting contributions? And that affects how the unfunded liability is financed. Think of it as a mortgage or any other type of debt, on a business debt. You project out your revenue and how that's financed. Next page, please.
So on the other side of things, we have our demographic assumptions. This is how the membership of CERS are going to act. On the mortality assumption, we increased our mortality rates to reflect a lower life expectancy for the members. And this is based on actual mortality experience for all of the members of KPPA. So that is about a 1.5 to 2 years decrease in our life expectancy. We saw higher rates of termination for active members. So this is members before they reach retirement. So we increased our termination rates there. As far as retirement, we saw members retiring at about the same rate and about the same age as they were at the last experience study. So no change in that assumption. And a smaller, less material assumption is the disability. We slightly decreased our rates of disability for our active members as well. So the biggest assumption changes there was that mortality and the termination.
Thing to note on the demographic, if people, on this committee remembers from 4 years ago, when GRS last did an experience study, was in 2018, there were a lot of significant changes, especially on the mortality and some other assumptions that really increased the cost. And what we saw here was this is more of a confirmation that the assumptions that were used still remain applicable because they were much smaller. And I would say the big one is the mortality, and we've gone through a pandemic. I mean, it was really a pandemic that on the data dependent, and we're still assuming life expectancy is going to improve in the future, but we've kind of had honestly, it was a setback in life expectancy, and we're reflecting some of that reality. You just can't completely ignore it, but we don't give it full credibility either. That was set on 9 years experience. We had 3 post-pandemic, which we factor in, but we've got you think on a credibility weighted basis, it's about a third. So 2/3 of that assumption is reflect on a pre-pandemic assumption. We go to the next slide. Let's go back to the investment return. This is the most subjective assumption. It's also one of the most important. We focus in the valuation, and our principal base is more forward-looking than historical. And if we go to the next slide, in that analysis, and I apologize for the small font, there's a lot of data in here. But to go through here, we look at the assumptions for Wilshire's in there. Wilshire's number 5 on the list. But we look at it on number of investment consultants. We look at it when they publish these assumptions. Some of them note, hey, these are more like they call them short term, 7 to 10 years, and more longer term, which is 20 to 30 years, and how things are looked. How the expected development of those assumptions are. And we also track actually from year to year to see how they change in the assumptions. And what we saw is just a remarkable increase in the expectations. That's because you're at a new starting point. When you think of 2022, interest rates were low. You were still fighting some inflation, but it was by and large on the yield curve, and the interest rates have dramatically increased, much of it driven by the Fed in this last, I call it 12, 18 months. And that is changing the forward-looking expectations. So while the last 18 months haven't been favorable in investment experience, it's setting you up forward to be much easier to earn those returns. And by and large, it can be achieved on a yield basis. So we're showing 2022 to 2023, you're going to see on each investment consultant in there how their expectations have changed over the year and the probability of exceeding a 6.25%. And then we got at the very bottom, the average for the 7 to 10 year and also the 20 to 30. So the purpose of this is to say, all right, you've got Wilshire, which certainly understands CERS's investment policy better than anybody. So they have an extra layer of expertise, but based on just capital market assumptions or expectations by asset class of others, we mapped to the investment policy and to see, all right, we want to know kind of the range and where it kind of gives this committee an understanding of the variance, at least of these 10 to 12 investment consultants, of what their expectations are going forward. They're all consistent. They all went up. And to us, it was sensible to recognize some of that. And, if you think of it on the portfolio experience, the portfolio expectation is much higher, where they increased maybe 1 or 1.2%. However, on the expectation, the return expectation, that was only bumped up 25 basis points. One other thing, it's not in there in the experience study, but it's in the statute of the board's funding or the funding policy. How's the unfunded liability paid down? This was commented, GRS made the comment during the board meeting. I think it's worthwhile to comment here that the legislators in 2020 modified the funding policy. While it was reset back to 30 years, it was also put in 20-year layered amortization. So any new gains or losses that occur are financed over a closed 20-year period. In our opinion, this is actually a much stronger funding policy now than back in 2017, when the assumed rate of return was changed from changed to 6.25. It was just a single layered amortization. So that's, to us, that you look at it in a totality basis, I think it's in a better spot. If we go to the next slide, I think we got some of the cost impact questions. This is for the non-HAS. What we did is we separately showed the current assumptions. This is based on the 2022 val. So it's just a pro forma. It doesn't mean that the actual rates are going to go down to that for July 1, 2023, as Ed mentioned, but this is a pro forma. How would the rates have changed? So you separately identified, do the demographic assumptions, namely mortality, and you build on that. So you have the demographic assumptions, and with the discount rate change, that the employer contribution rate would go down by 2.82%. That's line 12. And then in terms of a dollar amount of the contributions, it's about $77 million for C non-HAS. If we go to C-HAS, next slide, we've got the same thing. Actually here, it's the discount rate makes a bigger impact. And then we've got both as a percentage of pay and the change in contributions. It would be 26 million. With that, we will open it up to questions and discussion.
Well, thank you to each of you for your presentations. I appreciate the depth that you've gone into to explain your process, and clearly you've put some thought into the process. I will probably have some questions here as we move forward, but I would open it to the floor for questions. Auditor Harmon, we would like to start with you.
Thank you, Mr. Chairman. Mr. Owen, if you go back to, I think it was page 4, the historical performance, I've got a question when it comes to, if you go down to fiscal year 2018 and you go over to the actuarial value of the asset and the funding level, it's listed at 5.27. Was that a clerical error?
I don't believe it's a clerical error, but I will say that this report is manually put together. There was nothing that we had that showed the historical performance this way. We we leaned very heavily on our investment office to get together the returns for us. But I don't think that is a clerical error. I think the 10-year in that year may have been just that, 522.
But you look at the funding status, and the funding status right above it is 52.84. The funding status right below it is 49.10. Are you saying the funding status for 2018 was only 5%?
No. Then that does, in fact, look like a clerical error.
Okay, that's what I was thinking.
Yes.
I just wanted to confirm that. Thank
Yes.
you. Thank you, Mr. Chairman.
Thank you, sir. Next would be Representative Bojanowski, please.
Thank you. I haven't been here for a while. Forget about how to push my button. On the pension contribution report, the increase in the member contributions, is that because there are more members or there are members with higher pay, so it's a higher percentage of their pay? Not a higher percent, a higher amount because of the percentage of their pay, or what contributes to the increase in member contributions?
Thank you very much for the question. I believe that the result of the increased member contribution is simply more employees. The assumed payroll increase from GRS is 2%, but our experience last year was a 7% payroll increase.
Okay, thank you. And one more, if I may. All right, so it really kind of caught my eye that our mortality has decreased. And I know that the impact of COVID was discussed in the research on the mortality. Is there any indication that people, they call it long COVID and it impacts you over time? Is there any indication that that might have an ongoing impact on our mortality rates?
JD, if you don't mind, I'll turn that over to you.
Sure. I guess the long story is, we will say that the mortality rates that we carried, and we did see higher rates of mortality over the last 3 years. We don't necessarily think that those high rates of mortality are going to continue. But we did want to reflect that in our mortality rate. So we did look at 9 years of the mortality rates for the KPPA retirees and beneficiaries, and we did use that as the credibility for our analysis. So as to the effect of long COVID specifically, I can't speak to that, but we are projecting those higher rates of mortality as a baseline. Now, I will say the majority of experts do believe that a mortality improvement is going to continue into the future, which means that going forward, that mortality rates are going to decrease, and that is an assumption that we continue to make.
Our report, it's out there on the KPPA website, I believe, or Ed can provide you one. And what we did is we actually showed the mortality, just the raw mortality rate by year for the last 6 years. So you have 3 pre-COVID, 3 post-COVID. And to me, one of my personal things that I was surprised about was I started to expect to see mortality improvement in this last fiscal year of the FY 2022. And we didn't see that. And it could be some of the long COVID stuff you mentioned. I think there's other things that I've read that can contribute to it. Is during COVID, a lot of people put off going seeing the doctor. So, they weren't keeping up with their, either diabetes, maybe they had some problems, either cancer or otherwise, that they put off because of the COVID that they're having to deal with now that impacts mortality. So I think that in response to your question about long COVID, I think it's a possibility. It could be an ongoing issue for a while, as well as dealing with the other issues, the other health issues, just simply from putting off seeking healthcare during those years.
Thank you, Representative Bojanowski. Next up is Representative Tipton.
Thank you, Mr. Chair. You were timely. I was making more notes for Ed here. I've got.
You have the floor for as long as you need.
All right, thank you. I do. I'll make a comment here. When we passed, General Assembly passed CERS separation a few years ago, I did support that bill. But one of the things that made me nervous, one of the reservations I had, that was that a future CERS Board of Trustees would change these assumption rates. I have a question for you. When the board made of trustees for CERS made the recommendation, was this a unanimous recommendation?
It was not.
Am I correct if I read the media reports it was 5-3?
That is correct.
Okay. Ed, I've got in your position with the CERS board, your other employees, it is correct that you have a fiduciary responsibility to the members of CERS. That is correct.
Absolutely.
Does the CERS Board of Trustees also share that fiduciary responsibility to the retirees and members?
Absolutely.
Okay, just want to get that out there. As I'm reading the contribution rates, of course, we know that the three main employers of CERS are Kentucky League cities, the counties, and our school boards. And there are some, like the state even has some CERS members. Go figure that. But of course, it's going to decrease the amount. The projection would decrease their contribution amount, and it looks to me, if I've added up the figures correctly from the has and non-has, the projected rates, they would have a decreased contribution of $103.82 million per year. Now, I understand that the funded ratio looks better because of the increased actuarial rate. My dad used to say paper will lay still and let you write anything on it. And, you know, you can make it 7 and make it that much better. I'm putting out a word of caution here, a word of concern that as a member of the General Assembly, as a member of PPOB, I'm going to be watching this very closely. Thank you.
Mr. Chairman, if I might.
Absolutely.
Representative Tipton, thank you very much for that. And let me first respond to the 5-3 vote at the CERS Board of Trustees. And I must say that our chairman, Betty Pendergrass, has done a tremendous job in teeing this issue up for the board. I was very happy that there was a robust discussion about what we were doing with the assumed rate. The no votes, if I could characterize them, were not that we weren't seeing the data that we saw, but that we maybe needed to wait a little longer. It was a timing issue, not an issue of whether or not the data itself supported moving forward. But that robust discussion, I think, is the epitome of every member of that board of trustees fulfilling their fiduciary responsibility to the members, because we got exactly what they thought and we moved forward accordingly. If I might, as to moving to 6.5%, still 2/3 of public pension plans are well over 7%, not well over 7.1% in terms of their assumed rate. We are well below them. The risk that we have in our portfolio, as David Lindbergh mentioned, we've received outsized returns based upon that risk. And given this and the asset liability study that we intend to do before the end of this year, we believe that we'll be able to take some additional risk out of our portfolio. So we understand, and I think the board was well aware when we teed it up and when it was voted upon that there would be some level of controversy concerning it. But we were confident that we had looked at all of the available information. And not only had we looked at it, we'd looked at it over a period of time. This process started approximately 14 months ago. And all during that time, if things had turned around, people's opinion on what we should do may have changed, but it did not, and the 5-3 vote occurred, and I am very thrilled that you will continue to watch this very closely, because I wanted to say in the opening, Mr. Chairman, and I didn't, that I am very excited about the oversight provided by this board. You make us better. You make us better. When I first testified here in April of 2022, I was asked a question by Auditor Harmon concerning proxy voting. And we went back after that meeting and determined, we don't have that as fully under control as we'd like to have it. So we started working on that the day after that meeting to correct the blind spot that we had as it related to proxy voting. Subsequently, House Bill 236 passes, requires that we do that. But we're in a position now where 11 of the 12 external managers, equity managers that we have already modified their contracts, modified their agreements, and we're in a position to move forward. This will take a period of time for anyone doing it, but because you made us better, we were well ahead of that curve.
Thank you for those comments. And next up would be Representative Pratt.
Thanks, sir. I'm over here. As I'm looking at the contribution report pensions, I look at the cost of the administrative expenses. That kind of concerns me. When I look at this, basically for 600, I'm assuming 604 million or billion. A total, because 142 plus 461.
It's in the report is in millions.
In millions.
Yes.
It takes 17.5. First of all, I'm a little concerned. My question on administrative expenses, I'm assuming it's 17.5 and the 1.5 are all administered by the same people. Is that correct for the non-hazardous and hazardous?
Yes, that would be correct.
So your administrative expenses is 19 million for 604 million. That seems a little high on the administrative end. And my other question is, why did it go up from 17 to 17.5?
Well, to answer your first question, the administrative budget for KPPA, and we're a part of that total administrative budget, is somewhere between $48 million and $50 million. This is what is apportioned to us, and there is a complicated formula that's used to determine what will be attributed to CERS and what will be attributed to KRS. Some administrative expense we split 50-50. Some administrative expense is based upon assets under management, and some administrative expense is based upon the number of members that we have. So this is a function of the formula that's implemented to come up with our overall administrative expense.
That still appears, again, to be a tad bit high. Even doing quick math, it's 0.02%. I know I got a 401k. If they charge me over 1%, I throw a fit. So my question is, why is it so high compared to a 401k company?
Well, I would say that we have 250 to 270 employees at KPPA, which administers this program, which is the bulk of the administrative budget, and a number of those employees are responsible for member attention. So we have, as an umbrella over KPPA, over 400,000 members. There are a number of members that have claims to be adjudicated, questions to be answered. There are a number of people that need to be in place in order to do that. And that the administrative budget is in fact presented to this oversight board on an annual basis.
Thanks, sir.
Thank you, Representative Pratt. Chairman Higdon, do you have any questions or comments, sir?
I do. Thank you, Mr. Chairman. And thank you all for your explanation. But I guess my biggest concern is history repeats itself.
Yes, sir.
Our pension plans are in the shape they're in today because of underfunding. And there's several here on this board, Senator Neal, Representative Graham, Auditor Harmon. We were here in that 2008 when the wheels run off of everything. And part of the problem when we started looking at it wasn't that the markets performed so well. It was just that our assumptions were out of line. Rate of return was out of line. Assumed payroll growth, and it was almost looked like it was not, as far as the actuaries were concerned, that's tended to be what was done across the country. Just to keep the rates high, so you can keep the assumptions high, so the rates that the employer was paying would be low, and that's what put us in the position we're in now, and we're doing the same thing again. We've struggled here the last few years to lower those assumptions. We've put a lot of extra money into the pension plans. I know Chairman Petrie and Chairman McDaniel, there was a lot of extra money that went into pensions last year, not necessarily CERS, because you're not ours anymore. You all divorced us. You've moved on. But in state police and KERS and TRS, we put a lot of extra money to try to shore those pension systems up. We didn't reduce the rates or the increase assumed rate of returns, which makes us look better on paper. But I guess my question to your actuary, Danny, when you make this recommendation, did you look at the funding ratio of CERS? It's not, it's not a fund that's 80 or 90 or even 100% funded. Why would you recommend a raise in assumptions for a pension plan that's 50% funded?
Yes, sir. I think it's a valid question. And in terms of the funded status, yeah, there was some consideration given in that. I actually put, Janie and I put more consideration on the funding policy that was put in. When you think about when the funded ratio was when those difficult decisions were made in 2017, and you had a closed funding period. It started off as 30 years, but it was walking down to, I think it was 28 or 27 at the time. And here in 2020, when it was reset back to 30, but you put in the 20-year layered amortization, in some ways we consider that an improvement. Because any new gains or losses are going to be amortized over a much faster period. So the contribution rates are going to react quicker. Let's say if there is some negative experience, they will adjust and increase on a faster rate to pay back that unfunded liability. So in that regard, we felt like, and we believe it's a stronger funding period or funding position. So it seems sensible to take back some of that other conservatism. I haven't used it in a while, but I'm going to go and refer to belts and suspenders. That if you think of your assumptions as part of your, the assumptions as part of your, your funding strategy, and you got your funding policy, how quickly you pay back the unfunded liability. As the other, it's like having a belt and suspender. You can wear both, but do you actually need both? So the fact that you're stronger on your funding policy now, which you weren't in 2017, that felt like it was at least sensible to broach the idea of you could pull back a little on the assumptions. Now, I say that, and we're really counting on the legislators or the General Assembly and not changing or modifying that amortization policy to weaken it or reset it back to 30, but hold it to where it is, because I've seen a lot of systems across the country And if you look at the ones that are stronger, it's not the ones that have the best assumptions or the most conservative assumptions, actually the ones that have the strongest funding policy. And yeah, assumptions go into that on the payroll growth. And, you mentioned the assumptions, but continuing to reset that 30-year funding policy was also a detriment to the funding period of CERS. And we did a stress test report back in a few years ago, 2020 or 2021. And we identified that was one of the most significant risks for CERS, was this continuation. If the funding period was reset every 5 years or 6 years back to 30 years, that was actually the most detrimental. And I think that where we are now is a much stronger place with the 20-year layered amortization. So that weighed into it. And, it's into the thought process and part of the recommendation.
Mr. Chairman, one more, please.
Please.
Ed, you've got a long time now before you vote on this in November and December, so I'm hoping that you reconsider and keep these assumed rates of return where they're at and keep the foot on the gas. And remind you that your fiduciary duty is to the employees and the retirees, not to the employers. And I know there's a lot of employees that are currently working and retirees that are looking for a COLA. And the law says we'll pay a COLA when we get to 100% funded. And I think this is a setback for us to get to 100% funding as soon as we can. So hopefully you'll reconsider.
And thank you very much, Senator Higdon, for that comment. And certainly the board, as they watch this oversight meeting, will hear that. And I certainly will communicate your sentiment as part of this oversight board to them. But if I might, on that, Representative Tipton indicated that the change in the contribution rate would decrease employer contributions around $100 million or thereabout. And we would like to think that, much as we saw with the insurance portfolio as we got over 100% funded and were able to reduce significantly the contribution rates for employers, that we believe that led to the employers actually turning that money back into hiring additional employees and being able to pay to keep the strong employees that they had. I believe that some of that is what the state of Kentucky did over the last year and a half by increasing employee salaries over 15%. You want to be able to make sure that you're able to keep the best talent that you have. And the cities and counties are no different and need to be able to do it. But it wasn't done for that. It was done based upon our total review of all of the documentation. And almost all of that documentation we've presented in front of this board today. And it speaks to a forward-looking, and we are long-term investors. It speaks to a forward-looking prospect of returns that are significantly higher than 6.5.
Is that anything else? As we wrap up, I do have a couple comments and questions. My first question, and I'll open this up to anyone. You may need to get back to me on this, but without these rate changes, what is the anticipated date where we would be 100% funded? Is anyone able to answer that for me?
My guess on that is in 48, Danny, in 2048, is that the year? Yes.
Yeah, the change in the assumptions, that goes back to your funding policy. You have a policy if you have an unfunded that's going to be paid down at a certain date, and the longest tier of that, or the longest tranche or layer, is that existing unfunded that was sitting on the books in 2020. And that is currently on a 27, this next year will be on a 27-year funding period. So it's about 2048, 2049.
Okay, and if we implement these rate changes, what will be the anticipated date to reach 100% funding?
It's the same date.
Okay.
It's the same date.
All right, thank you for that. I wasn't clear on that, so I appreciate that. I want to go back to the process that you guys have gone through, and I appreciate that you've had a very studied process on this. But I was curious. You do have an actuarial subcommittee, correct?
That subcommittee has been turned into a full committee.
Okay.
So it is, yes.
And what was their position on this change?
The actuarial committee did not make a recommendation to the full board, and there's a reason for that. This committee, and the actuary committee, is made up of 3 individuals, and the normal course of governance for us and most other institutions is that a committee will make a recommendation to the full board for ratification. This issue was of such great import that it was the committee's determination that they did not want to make a recommendation to the full board. And I believe, and I'm only speculating here, I believe that had to do with when you make a recommendation for ratification, there is a inherent tilted bias toward whatever that recommendation is. It may only be slight, but I believe the committee itself determined that because this was such a weighty issue, that each of the 9 members, based on their own individual fiduciary responsibility, needed to come to this fully cognizant of what, in fact, they were voting on, and their up or down vote would make a difference in terms of the decision made by the entirety of the board.
Okay, I would think that actually that's the purpose of a committee, is to provide input and I don't want to say take the full board in one direction or another, but at least provide their input. Otherwise, what do you have that committee for? But that's a conversation for another time. We do have a couple of other questions. Senator Carroll, if you have a question.
Thank you, Mr. Chairman. I do. You spoke a little bit about the issue of timing. I don't know that there are many economists who would disagree with the statement that we are facing a recession soon. Talk a little bit about what happens should that fall into place next year, the following year. Will you all be ready to turn right around and increase the assumptions?
Well, if I understand the question correctly, would we be willing to turn right around and decrease the assumed rate? Absolutely, we would, and that's why this is reviewed on an annual basis, because we're making the very best determination that we can based upon the most recent and up-to-date information that we have.
And I understand that, but help me understand the logic of doing this when there is so much of a consensus that we're facing a recession. It seems like that's going to affect the credibility of the board as a whole to take a step of this nature during these times. And in adding to that, you talked a little bit about the retirees, and I understand what you're saying to be able to hire employees now, but what is your message going to be to the retirees that haven't had a COLA in, 15 years? Many are getting more elderly now and relying strictly on a pension. Many that did not pay into Social Security or will draw reduced Social Security. What's your message going to be to them? I think that's important in this discussion.
Well, Senator Carroll, thank you for that question, and I'll take that question first. We understand that anything related to a COLA, there are only 2 conditions under which CERS can do that. The first would be if we are 100% funded. We are not. The second would be if the General Assembly were to actually indicate that we should, then we would. So one of those two things would have to occur before we could consider it. In other words, that decision is not in the hands of our board because we are not 100% funded.
$100 million a year is going to slow down the efforts to be 100% funded?
I don't believe that it will. I think the forward-looking projections of not only the investment consultant that works with us, and let me say that I am tremendously impressed by the work that has been done by the Wilshire Group and the work that has been done by GRS. These are best-in-class professionals, and they're both looking and using the best information available to determine a forward-looking analysis that has been done for 40 or 50 years. It's only in the light of what may or may not occur in the near term that some might be given pause about the wisdom of moving our rate now. But we're looking at what we see and basing our decision on that, as opposed to what may occur in the broader economy over a period of time, which we will have an opportunity within 12 months to reevaluate, if that in fact does occur.
Thank you, Senator Carroll. Chairman Petrie.
Thank you, Mr. Chairman. I think I've heard some of the same sentiment from Senator Higdon and Senator Carroll and even Representative Johnson. I'm not sure that I'm seeing the benefit to the retirement participants in adjusting the assumption, especially on the rate of return. Even if your actuaries, and I don't dispute this, say that, well, with this change and with future changes, we're within our time frame of reaching 100% funding, that this won't delay that. I think, well, all else consistent and held steady, $100 million not going into the pot will not hasten. Whereas if it did go in, the assumptions remained, then it may hasten the timetable for reaching 100% funding, which would seem to the benefit psychologically and physically to the participants. I would really ask that the governing body seriously consider what actual advantage there is to the participants in the retirement system and the hastening of the full funding of that retirement system by leaving these assumptions steady as opposed to changing them and decreasing in the very near term how much money will be going into the systems. I would just echo some of the comments earlier and ask for very serious consideration to be given about that. Thank you, Mr. Chairman.
Thank you. And I would just reemphasize that. I don't want to pile on, but I'm going to pile on a little bit. Okay. We have gone through a few years ago a very painful process to get our assumptions to where we are getting the fund healthy.
Yes, sir.
We will be very concerned about anything that takes away from that 100% effort to get that fund healthy. Yes, this feels like it does that. So I would just echo for the third or fourth time now that we're very concerned about what we're doing here. We would hopefully, we hope that you will look at this again very carefully with the long-term benefits of your employees in mind.
Yes,
I
sir.
hope that makes sense.
Yes, sir.
I wanted, before we wrap up, and I'll let you go in just a minute. We've been
Okay.
at this quite a while, but you made a comment, mentioned something I'd like to just touch on. You mentioned when you were talking about proxy voting that you've got 11 of the 12 management funds. Is that the right term for that?
Yes, sir.
You've got 11 of 12 on board with what you want to change. That's the same number that you mentioned the last time we met. Is there any progress with that 12th group?
That 12th group, thank you for that, Mr. Chair, we're going to have to structurally change part of our agreement with that 12th group. And we're in negotiation with them now as to how we change that, because it relates to our not actually owning some of the underlying stock in that. So we've got to materially change it. We're talking with them about how we do it, but we're also looking on the off chance that we're not able to come to an agreement in a timely fashion, how we pivot and achieve the same goal with another manager.
That would have been my next question. Was it a potential that there might have to be a severance of the relationships there?
Yes, sir.
And you're going to have to do what you have to do, and we understand that. Thank you for that. I kind of deviated it there a little bit. Are there any other questions from the board before we move on? Seeing none, I want to thank you, Mr. Owens, and all the presenters for a very in-depth presentation. We appreciate your candid comments and the information you've given us. We look forward to hearing from you again down the road.
Thank you, Mr. Chair.
Next item on the agenda is a report on employee contribution projections and impact on the state budget by our own LRC staff. So I'll let the famous Mr. Gross come forward, introduce himself. Anybody else, if he's got anybody that wants to speak with him, and the floor is yours, sir.
You see here, slideshow. Alrighty, I'll go ahead and get started. I will try to be as brief as possible. Hopefully you've got all your questions out with the last presentation. But today what we're going to talk about is when we look at our retirement projections, and all the retirement systems are required to project cost out into the future, one of the big questions that it often comes up is how much of the general fund, our state tax dollars, are we going to have to expend for this purpose? And kind of before I begin, I just want to thank our budget staff. Some people think I'm on budget. I am not. But Zach Ireland, who's sitting back in the back, he really doesn't want to be recognized. He's incredible at what he does. He has spreadsheets that dim the lights around here. He does a great job, and his partner Perry Papka and Liz Columbia and Seth Dawson on the education side that deal with these pension funds from a budget perspective do an incredible job. And I will just tell you, a lot of what we have here today is because of their efforts as well too. So that being said, just very briefly, we're going to look at all 6 of our state-administered retirement plans. Certainly KERS, SPRS, which are administered by the KRS Board, CERS, which is now administered by the CERS Board, Teachers Retirement Systems, and certainly the Legislative and Judicial Plan administered by JFRS. When we look at retirement costs, we're a little bit of an anomaly in that we have both pension and retiree health combined in our pension funds. And so when we look at numbers, when you look at these contribution rates that Mr. Owens went over, there's a contribution to pension, a contribution to retiree health, and in the case of TRS, there's actually a contribution for life insurance as well too for that benefit. So the purpose of what we're trying to do today is certainly not to talk specifically about the next 2 years of the budget. In August, September, you will have folks come in and have their projections as they kind of lean towards this 2023 valuation. Really what we're trying to do today is look at long-term trends and projections. Are they going up? Are they going down? And just as some reference point, there is a lot of things that have changed over the years that have come out of the PPOB. As far as when we look at things like this, first and foremost, all the retirement systems are now required to have 30-year projections in their valuations. That was a PPOB recommendation several years ago. So one of the nice parts is we can pull those valuations up and look at those costs. Now, it doesn't always give us a general fund cost, so that's kind of the difficulty we have in trying to figure out what it means from a budget perspective. Secondly, we're also in process as we hit towards the end of the year, All these retirement systems will be starting on their 2023 actuarial evaluations, which will finalize their upcoming budget requests. And there's two things that are kind of big, certainly the experience that will come from FY23. And then another thing that's come out of this oversight board has been some consistency in evaluating assumptions. All of our retirement plans over history have done what's known as an experience study that you just saw from CERS. The rest of them will be coming in either through their valuation or later in the year. But they all have to review their economic assumptions once every 2 years and their demographic assumptions once every 5 years. In the case of CERS today, it was everything, demographic and economic. So that's the other side of it. We're looking at long-term trends because we know that the numbers that are probably closest to us when they come from this next valuation will be a little bit different. We hope to kind of understand, and some of this will be old hat for you all, but just to understand that there's an individual system interaction within the budget. Some of them, the money that they request from employers is all general fund. Some of them it's most. Some of them it's not very much at all, or honestly non-existent. So to kind of see that interaction, just to talk about it a little bit, and certainly again, those costs include pensions, retiree health, and in the case of TRS, life insurance. And then lastly, we'll approximate some general fund costs for the applicable systems as we look forward. I will say this is not a perfect science, particularly as it relates to KERS, CERS, or SPRS, in particularly KERS, where you have general fund, federal funds, trust and agency accounts. We appropriate money for our state agencies to help budget, to help fund those costs. But ultimately, how they pay for that, that's certainly a good question. That general fund number can be all kinds of different things. And if you were to call KPPA and ask them, they just know the money's green. So when that last thing I had on there was talking about that the variability. Now, there is a lot of data on this sheet, and we are not going to walk through all of it, but this is just to kind of show a little bit of the volatility and things that can change very quickly when we talk about our pension funds. So looking over at the right-hand side, we have a pension cost, we have a retiree health cost. If you'll look at the top, KERS non-has. In 2018, that fund was 36.4% funded with a $1.5 billion unfunded liability. Look to the far right. That is now 79.1% funded, $374 million unfunded liability. Big, dramatic reduction. And if you look at KERS hazardous, 172% funded now. State police, 100% funded. CERS non-has, 132. C-has, 101. Big, big changes. And one of the big changes that has occurred has been that the Medicare eligible plan in particular, if you'll notice that big jump between 2021 and 2022, the Medicare eligible premiums went from $252 per person to $87. So we had a big jump, big change that significantly reduces unfunded liabilities, which has an impact on cost. So if you were to, I will tell you 2 years ago, somebody said, when will we be 100% funded in some of these? I would have said 5, 10, 15, 20 years down the road. Well, guess what? It's today. Would not have anticipated. So there are things that change. State police, if you look on the pension side, between 2021 and 2022, you have that $215 million of general fund appropriations that went in, and that fund went from 30.7% funded to 52.5%. As those stats improve or deteriorate, that changes the amount of money that's ultimately going to have to be paid into these funds. And so this is just to see some of this data, but to also understand at the end of the day, our unfunded liabilities are our cost. We are not a place where we're paying normal costs. Most of our costs are to pay down unfunded liabilities. And so as these improve, certainly our costs go down. This is just something to, I like new stuff. I've seen people do these box plots. I like them. But this is just to kind of give us an idea of where is our unfunded liability at. And so you can kind of see from a standpoint, particularly as it relates to the state budget, we have two big ticket items, KERS non-has and TRS. CERS is largely not a budgetary issue. The only thing we have there is we have the circuit clerks that are in the judicial branch budget who transferred from KERS to CERS back in 1996. And so we appropriate some monies for them to pay their CERS non-haz rate. There are no CERS hazardous general fund contributions. And then you'll see that small purple group down at the bottom. That is largely KERS and SPRS. But so you can just gives you an idea of that. And then just looking on the right, you can kind of see our combined retiree health obligations. It just gives you an idea of the variability of where we're at, but also that it's improved. I would have never expected to say we have 0.6 billion combined unfunded liabilities for retiree health. It was much, much more when you go back to 2007, 2008. It was bigger than the pension side. That's when I say the world changes quickly, it can change quickly. So what are we going to do today as far as showing some projections? We're going to show you some projections through 2050. We're going to look at the total employer cost, which means all employers, all funds. Try to estimate some of that general fund component. We're using the June 30, 2022 data, except for LRP. They do a biennial valuation, so we're using the 2021. And like I mentioned, the percentage of general fund varies by system. I'll talk about the simple ones first in general, but LRP, JRP are all general fund sources. I will tell you their current projections through 2050, and the time frame we're looking at is 0 every single year. For TRS, it is pretty heavy on general fund, particularly as it relates to the pension side. We do on-behalf payments in the KDE budget. So you'll go to the education side and you'll see an appropriation to KDE there. And as many of you all know, about 2007, 2008, 2009, that's for the fixed statutory rate. That fixed statutory rate was no longer sufficient to pay off those unfunded liabilities, and we are now making an additional ADEC contribution, which is on top of that directly to TRS to help pay down that unfunded liability. And then certainly for KERS, CERS, and SPRS, what we're going to do as far as projections is just try to use our 24 numbers. And I will say for KERS, it's become more difficult to look at, and only because of House Bill 8. Not that House Bill 8 is bad, but we are now providing appropriations, more appropriations to quasi-governmental entities in KERS to help pay the bill. So one of the big questions we have as staff is, will that continue in the future? Will it not? We're actually going to look at it two different ways, is if it doesn't and if it does. And probably the CMHCs and health departments want to make sure that it does. I won't go through a lot of this because I think I've hit all of this in general. This is the, hey, make sure you tell them what you're doing, and the budget staff, they like to be particular about numbers, and so this is kind of the warnings, if you will. I think I've hit all of those. Zach, am I okay? All right, good. Trust Zach on that one. But we'll go ahead and kind of move into this. And so the first, honestly, almost entirely our general fund costs are going to be eaten up about 95% from KERS, non-hazardous, and TRS. And this is just to kind of give you an idea. So the big blue boxes or columns that you see there are the projections that come from the retirement systems for the next, 25 years plus here, as far as everything that they're projecting to receive. There are two lines below that are estimates of potential general fund. The red is without any subsidies to those quasi-governmental entities, of which we're paying in excess of $100 million of subsidies right now. And the blue is if those subsidies continue in a relatively same share, if you will. So in these examples, we're looking at roughly around 43% general fund with that red line, 52% general fund with that blue line there. And as you can kind of see, we're roughly estimated at 589 million right now. As we move forward, certainly those policy decisions will come up about House Bill 8 subsidies. I will tell you the bill speaks of that number lowering over the course of time. We have not to date. You will probably notice that number comes down and then goes back up to a very similar level. That is where I talked about that health insurance. You may remember Danny with GRS talking about our 20-year tranches. Well, a lot of this is essentially that gain that we got from that Medicare eligible premium that we're going to get for 20 years. And then it pops back up, if you will. And then you'll see at the very end there where we have the drop off when the unfunded liabilities are to be exhausted or be paid off, if you will. And we move more towards that normal cost scenario. For reference purposes, just as far as total cost, I just showed down at the bottom, what did we pay total dollars all in from all employers, all fund sources in 2000 and 2010. You can kind of see 192 million, 238 million, 2000, 2010. It's in excess of $1 billion now. Now, the good thing I guess you do see here is some stability as we move along. Certainly, this is a very mature plan. If nobody has questions, I'll move on to the next thing. TRS, like I had mentioned about the statutory rate, the direct payments, and the total general fund payments to it. One of the things that they're certainly experiencing, you may remember in the PPOB a couple years ago, they had an experience study in general. I think it was around $3 billion of additional unfunded liability between all of their funds. And their board made a decision to smooth in the impact, the cost to the employer over a 5-year period in 2021. That was also coincided with really good investment returns in 2021. Certainly 2022 was the opposite of 2021 as far as investment returns are concerned. And so we are seeing a growth in that contribution rate as we move forward, but also in relationship to payroll growth and other things in there as well too. So their cost is growing in terms of dollars and general fund dollars. So we just left KERS non-HAS where we're looking at 42, 43 to 50+% on general fund cost. In terms of the pension side, it's about 94% general fund when we get to it. So the other thing I need to talk about is the TRS Retiree Health Fund. You've heard Bo Barnes talk about shared solution that was passed in 2010 that raised employee contribution rates. School districts started contributing. The state is contributing additional money. Technically, that fund is receiving more than the actuarially determined contribution. It is projected to be fully funded by 2030, but there is not really a mechanism to unwind that when it gets fully funded. So I did ask for general fund projections from TRS, and because there's not a specific unwinding, if you will, it's the projections that I have general fund wise are that things continue as they are. So this is the pension side of the equation, and you can see that in FY25, total contributions coming in of $1.3 billion, 1.2 of which is general fund. You can see that kind of sharper turn as those costs for those assumption changes are smoothing the employer rate, and it continues up above $2 billion, capping out at $2.7 billion, of which $2.5 is projected to be general fund cost in 2043. And then you can certainly see, like similarly, when those unfunded liabilities are being paid off, I should say the unfunded liabilities are paid off at 2047. That's a typo on my part, copied over from the prior one. If we were to include the retiree health projections, of which I will say there's going to be a question of what to do with that and what will costs look like when we hit 2030 or whenever it's fully funded. But that gives you that number adding in the retiree health component as well too. So last of all, this is just kind of showing you everything collectively together. The blue is KERS non-HAS, the orange is TRS, and the green is everybody else, which that is largely KERS hazardous and state police. So I don't have much more. I hope that was short and sweet, but I will take any questions if you have them.
We will start off with Chairman Higdon.
Thank you, Mr. Chairman. Brad, that's not a misprint. We're going to be at over $2 billion to TRS in just a few years.
Based upon the current projections from the valuation, yes, sir.
$2 billion. Just that's hard to digest. I just wanted $2 billion, 2 with a B, right?
Yes, sir.
Thank you.
Representative Bojanowski?
Yes, thank you. On a couple of the different charts, it shows a significant decrease due to U of L being paid off. Could you just explain what that is?
Well, it's definitely not the University of Louisville. So,
Oh, unfunded liability. Okay, then that makes much more sense. I retract my question.
I'm sorry. I meant to be silly.
No. Representative, a lot of people had that question.
Yeah.
Nobody else was willing to
No,
ask.
I'm willing to ask.
No.
So yes, I understand.
Yeah. So just to clarify too, to make sure I answer the question, all of our retirement systems are essentially on a similar process of paying off unfunded liabilities. KPPA, KERS, CERS, SPRS is statutory. TRS is it's mostly board policy, but they operate the same. They have a legacy liability that they're going to pay off, and they started with a 30-year period and at different dates. They each have these 20-year for anything that's new. Gains or losses are going to get factored into that. And so when you see those tremendous drops on each of these, that's when they're supposed to be 100% funded and our unfunded liabilities are paid off. And if I'm around, I will probably cheer at some point when all of these are paid off. And I think probably Bo Barnes and many of the other folks will do cartwheels if they still can. So.
Senator Mills.
Thank you. Thank you, Mr. Chairman. Brad, in case you maybe have the historical knowledge, I like this at the bottom on the TRS employer cost graphic where it said, for reference purpose, fiscal year